So after we talked about cash flow, the WCA account, and tactically how to invest the money, I then go and show them how this would work. And I think the living balance sheet, the cash flow room in particular, is great at being able to do that. And I prefer cash flow design. I know there are other ways to do this in the living balance sheet. This is just what I like to do. And I'm just going to expand this here. And you'll see what we've built here. We basically built two different layers. We've built, and I'm going to tell you what we're going to do, and then I'm going to show you why we're doing it and how we're building it. I've got roughly $36,000 a year of investment money. And if you think back to the case, we had about $48,000 a year to invest. $12,000 is going into cash equivalents, right? So I'm not going to really talk about how we're going to invest it since this is more of a savings tool. And we're going to talk about the $36,000 remains, $12,000 going into fixed income, $12,000 going into equity-based income, and $12,000 going into appreciative equity. And we're just going to talk about the growth rates on those different buckets. And we're also going to talk about that. In the worst case, they're going to own term. They're going to own a lot more term than this. And as I tell them, they're going to see in just a second why I put this amount of term in place. But for Dave, who was 37, 38, per 750 of term, it costs about $1 million for a 20-year policy. And I'm just going to orient them and say that you're putting $36,000 in a year. We're assuming that the equities grow at 6%, the fixed income grows at 4%. And on a nice linear basis, if that happens, the account takes off in its fashion between now and age 60-ish. All the while, taxes compound. Okay? I sometimes show them this because not everybody understands ledgers. I like the current deployment a lot. You'll see I used this with this client actually last time we met. Simply to show them, you know what? Right now we're going to have at least $1 million worth of a 750 of term. They already have this on the books, right? They have double this. That they pay $1,000 per 750 right now. They're going to, on top of the $12,000 going into money markets, they're going to take $36,000 a year and invest it, right? Taxably, we already talked about that. And every single year as it grows, at the end of the first year, it will be worth a little bit more, right? And then on top of that, every single year, as we have earnings, as we put $36,000 in and it grows to $37,800, that extra $1,800 worth of earnings produces a tax, right? And there's different sorts of taxes made up in there, but we're looking at the first year's tax of being $540. And as the account compounds every single year, so too does the tax. Okay? And I usually bring this all the way up to the end so they can see that cash flow remains the same, the account compounds, the tax compounds. So this is exactly how it happens. And then I generally show them this current details ledger again. Now, I'm going to break here and talk to you, get off my narrative with the client and talk to you about how we kind of build this case. Because we do a lot of these cases in this way. Where half the case is what I call a new money case. And you'll see how we're building this. So I'm just going to, you'll see it's really based off of savings 1 and savings 2. And for savings 1, you'll see we're going up for 25 years. And you'll see that this is kind of our bond portion of it where it's a taxable account. I said 4%. Actually, we're growing this at 5%. So we're going to assume that bonds grow at 5%. Taxable, right? If I use munis, I would probably put 4% non-taxable in. With term insurance of $1,000 there. Okay? And if I were to graph that in the current details, just so you can see with clarity what we're doing, here it's $12,000 a year, and this is the bond portion with the term. In addition to that, we have the equity portion. And within the equity portion here, so I'm going to savings 2, it's simply $24,000 a year, growing over time. We could grow the equity portion to be at whatever we want it to be, and you'll see in just a second why that is. So I'll make this be 6% and 6%. We don't include any of the protection cost here, and you'll understand why in just a second as well. And so whatever we're doing here, we can simply drag that in and of itself, right? Absent of the bonds, and say we've got $24,000 a year growing in this fashion. And of course what we do is we put them both together, right? We kind of pancake them, check off savings 1, savings 2, and as we looked just a little while ago, we can see the macro effect of this is bonds and equities growing at their own rates with their own taxation along with the term insurance over time. Now, last part, as we talk advisors to advisor, for how this works, we go in just to savings one, just to the bond portion, because what we're going to also show them is not only how and what to save and how to save tactically in these different buckets, but we're going to give them a bond alternative. And simply said, this is what we do, and all we do is we go to alternate strategy here under scenario one, click alternate strategy, and choose, we've already done this for this case, simply choose instead of none, we choose permanent here, and we take that $12,000 that was going to bonds and move it into the permanent solution. And we could have recaptured the term, just didn't do it on this case, right? Didn't have to use that term premium to actually buy even more insurance. And we showed a benefit there. It just happens to be about $750,000 out of term insurance, but of permanent insurance. So that way, again, as we're talking to advisor, when we show the alternate detail in just a second to the actual client, we're going to be able to show now, instead of $36,000 going in here of all new money, $24,000 is going to go in. And we're going to take $12,000 that was otherwise going to go to fixed income and put it into our new fixed income. And generally this is, as we go back to the client narrative, what we say. I talk about there's different types of fixed income in the world. And if you had a fixed income that acted like this, that you had a prospectus that was written so that our new fixed income alternative has a guaranteed dividend interest rate of 4%. As it grows over time, it's guaranteed not to go backwards, which is a fairly interesting guarantee. If you could wave a magic wand and not have any of your assets ever go backwards as they grow, things would work well. In addition to that, it's uncorrelated with any other asset class, meaning that if interest rates go haywire, or things happen weird in Greece or Spain, or if the stock markets take a plunge, the account just goes up. It's uncorrelated. And it's a cash equivalent, which is very much one of the things that we look forward to for our fixed income. That on any given business day, I can access 100% of my money. Happens to have a death benefit, happens to have strong long-term care provisions associated with that death benefit, and happens to have a waiver of premium, at least for this case. So it is if it were a fixed income instrument all by itself, though, it would be a pretty good fixed income instrument. And again, this is where, instead of putting all 36 here, you put $12,000 into this new fixed income. It happens to be called whole life insurance. It has all the same properties as I discussed in that fictitious asset just a second ago. Guaranteed to grow, guaranteed never to go backwards, uncorrelated cash equivalent, happens to have a death benefit, happens to have a waiver of premium, etc. And when we do that, when we start putting $12,000 a year in, suddenly the $1,000 that we were spending on term, that we would otherwise at least have been spending on term, we can start saving that again. So now instead of $24,000, it goes up to $25,000. And our tax is flattened the tiniest little bit, right? Because the fixed income, its earnings were all taxable before, and now as we go into what is almost like a super municipal bond, we don't have to pay those taxes. And at least in the first year, they're about $180. You notice the red number here, we have total taxes of $238 in our alternate, and in our details, we have taxes of $329,000, right? The difference is simply flattening the taxes and taking the fixed income and making the returns never taxable. Now, I don't spend actually an enormous amount of time on the ledgers. As soon as I have some clarity that kind of knows at least the general direction I'm talking about, I quickly move to the graphs. I think pictures are worth 1,000 words, and more than that in numbers, and we're simply going to show them this is what you're doing now, Mr. Client, $36,000 a year tactically being invested, and this is the other side of the coin. The same $36,000, we just are showing you a fixed income alternative. And I asked the client, what does he see to be the difference in the two? And I'd like to know the answer. And sometimes they say, well, I don't know what the answer would be. And that's fine. Sometimes they say, whatever's on their mind, they tell me, right? And that's what I need to know at that point in time. I didn't usually point out the fact that what the graph doesn't show is that none of this is guaranteed, and every single year, more and more of this is guaranteed. Says our new fixed income alternative, the whole life, is guaranteed never to go backwards, right? Guaranteed on the way up, guaranteed never to go backwards. It's a pretty important attribute. When you're in your 60s, in your 70s, in your 80s, that's all that you really want in an asset class. But don't expect a 37-year-old to really appreciate that today. They are more accumulation minded. They want to make sure that this isn't going to cost them anything. So the entire reason that I use, well, the cash flow design room for this kind of stuff is to deal with the issue of cost. They think that $12,000 is the cost for the whole life insurance, and it is not. They could get their money back, and it wouldn't have cost them anything, versus the fixed income that they would have otherwise put into. Also, we avoid the conversation of, well, you know, if I put that $12,000 into the S&P 500, wouldn't I have more for my money? That conversation never comes up, right? Simply because we're already allocating some of that to equities, right? This is just for the fixed income. They've already got the cash into the cash flow, into the habits, and tactically that $12,000 needs to go into fixed income. This is just an alternative. And of course, we're going to deal with the issue of, well, at one point in time in your life, term insurance will go away. And at the very same time, you have so much more permanent insurance, right? So maybe at age 61, they feel like they don't need life insurance, even though we believe that they will want it at that point in time. They'll be indifferent from an asset value perspective, even though most of this will be guaranteed and uncorrelated. And along the while, we are simply allowing them to very much understand both the cash flow, the habits, and how this fixed income alternative is a good way to look at an allocation into whole life. The last thing I do is I usually come back to this graph. So I show this alternate details ledger rather. I go to the graph and I come back to the alternate details to just tie a couple numbers to let them know that our net value of lifetime that we were just looking at on that green graph is the combination of our total assets plus our cash values. I want them to understand it. I want them to see it so that I can email it to them afterwards and they already get it. So I want them to understand that this number and this number equal to $2 million, and it's the same $2 million that they would see at the end of this graph here. And again, I know that cash flow design can be used for a lot of things. I see advisors showing cash flow design with these ledgers that go from age 38 all the way out to age 90, right? Showing distributions and stuff like that. But I don't think clients retain that. I don't believe that they have a lot of want into that. They're trying to save the best they can at this age. They're trying to get good habits in force. If I have trouble seeing, this is the way I look at the world at least, that far in advance, right? I don't expect the client to see it as well. I certainly don't expect the client to make an investment or a buying decision on that. So this is used just to simply deal with the issue of cost and understand that the fixed income alternative is not going to cost them anything. If you got that on top of the human life value, wealth building potential discussion, on top of the cash flow and the habits, this will be the easiest thing for you to have a discussion on. And the last point is if you jump straight to this and just talk about putting $12,000 in the whole life, clients will come back and they will object to something. They're going to object to something here anyway, probably. There will be just good questions like, why whole life? Or, well, what do we do if we need the money in 10 years? These are questions they would ask even if they were just regular old investments, right? They're good questions. When you don't go through the cash flow and the habits before you get to do tactically what to do with their money, and you don't have checkpoints to understand, you know, are they on the same page with your cash flow and habits wise before you get the tactical solutions. They'll come back with questions, and you really don't know where the questions are coming from. Are they in fact related to the fact that they don't think they have $48,000 a month a year to save? It's related to the fact that they don't know how the habits of saving. They've never been able to in the past, so they don't know that they'll be confident enough to do it in the future. Or is it that they simply don't understand something about the investments that I'm recommending? I look at it kind of like we're attorneys in a courtroom and we're walking the client through the motions, and we don't move forward until we are on the same page with the client, questioning wise. So, my favorite question to ask, and you'll hear this again and again, is, Mr. Client, what do you like and dislike about what I've shown you so far? When we get through protection meetings, what do you like and dislike about the day? We get through our cash flow discussion, what do you like and dislike? Because they tell you the truth. When you get through the wealth coordination account and the how to allocate things over time, what do you like and dislike about this? They'll tell you the truth. They'll tell you, I don't know that we can do 4,000, or so much of your income comes in bonuses. I don't know that we can do it exactly like that, or I don't understand something here, or I love this. Or they may come back and say to you, when you talk about tactically, what do you dislike about this Or what do you like about this? Or things of this nature. The same thing. I'm pausing. I may ask that question 3 or 4 times in a meeting because it gives me that pause. I know the client's on the same page with me. And I know that before we move forward, I want to understand where we stand and what their level of knowledge is before I push forward. So that's it. Thanks.